Okay, so first of all, I sincerely apologize for the delay, and sometimes quality takes a little time, and I wanted to make sure you get the real value, not just rushed content. So now welcome back to the session 2 of XMC concept, and now let's move one level deeper. You have already understood how structure works. Now it's time to sharpen your edge by learning when to trade and when to stay out from the market. So in this session, we are diving into a powerful concept called balanced market versus imbalanced market. This is where smart entries and sniper timing begins. I repeat, balanced market and imbalanced market. From today, you will start seeing the market with a more advanced lens. So let's start this session. Okay, so before entering any trade, you must ask, is the market balanced or imbalanced? Because that also decides whether you trade confidently or sit out smartly. Normally, when the market is in a good trend, has a clean structure that is giving good moves, there are higher chances that we can earn more money, hold better trades, and remain profitable during that period. So, whatever your time frame is, when the market moves with structure, moves impulsively, that's when we trade, okay? But when the market is balanced and when it is in range, then we don't trade, or you only trade if there's a very high probability or very high quality setup. Most of the time during this phase, you should avoid trading because the market is simply moving within a range. So now the question is, what's the balanced market and what's the imbalanced market? So in a balanced market, price moves within a range, not trending aggressively up or down. First of all, if we understand balanced market, then normally when the market is moving within a specific range, when the orders of power directions are equal, the orders of sellers and the orders of buyers are equal, because of which the market moves within a specific range. Okay, so when the market is ranging between a clear high, low, and a midpoint, it's considered a balanced market. So this means neither buyers nor sellers are in full control. So we avoid trading during this phase. However, if we see a liquidity sweep followed by a strong impulsive move and it aligns with a larger trend or structure, that's our signal to engage. We then start looking for entries in that new direction. So again, in a balanced market, a price travels between a defined high and low. When the price hits the high, it moves down. When the price hits the low, it's move up. This back and forth forms are a neutral zone where no clear winner exists. Neither buyers nor sellers are in control. It's unpredictable and offer no high probability direction. But once a breakout happens, usually after a liquidity sweep and other buyers or sellers dominate, the market shift from balance to impulsive movement. That's when direction becomes clear and real opportunities begin. For example, when buy orders dominate, the market begins to push up, giving you a bullish impulse. And on the flip side, if sell orders take control, you will see a bearish move start forming. So this is how the market shifts from neutral to directional. So now understand this deeply. When the price is ranging between a high and low, it's a balanced market. No clear winner, buyers and sellers are equally matched. In this phase, we usually avoid trading or trade cautiously. But after this, What comes is the balanced phase, sorry, the imbalanced phase. In imbalanced phase, orders accumulate within the range. Eventually, one side overpower the other. Then we see an impulsive breakout forming a clear trend or structure. That's when the real setup begins. So simply when the market is in a range, then it is a balanced market and we usually avoid that. And in imbalanced market, normally what happens is after a balanced market, you get an imbalanced market. When the market moves in a range, there is an accumulation of orders, and only after that you see a plane, a continuous structure. So in short, after a balanced market, we often transition into an imbalanced market. So what is an imbalanced market? It's a phase where the market moves rapidly and aggressively in one direction, either up or down. This fast movement leaves behind imbalances, visible gaps where price didn't fully trade or mitigate previous zone. So after balanced market, mostly you get to see imbalanced market. Now what is happening in the imbalanced market? The market is moving very fast and with a lot of momentum in one direction. Because of this, there is a lot of imbalance and a lot of gap is left unfilled. So this kind of market is called imbalanced market. Suppose as an example, the market is moving in one direction. Now there is a clear gap between the wicks of the candle. They are not hitting each other. They are not mitigating each other. In this case, the market we have is an imbalanced market. So the summary of the balanced and imbalanced market is balanced market is equal to slow sideways range bound movement, no clear winner. In imbalanced market, fast, directional and powerful movement and one side dominant. This imbalance often needs to be corrected or filled later, which gives you a strong trade opportunities. So this concept works in the same way in every time frame. Even if you open a minute, a weekly time frame, or any other time frame, this same concept works in the same way in every time frame. So suppose if you look at this example, here we have the clear structure, clear trends. If you look here, you can see the clear moves. In this case, the market will be imbalanced. In this case, we get clear entries, good entries, and the chance of them working are very high. They are high quality, high probability setups. In imbalanced market, we can even saw a balanced market. We can see the market moves in a specific range, a specific high, a specific low, and again we can see the continuation and our structure continues. In between, we can see the new range of structure and trading. And in between, we can see the trades in our direction. So this is a major difference between balanced market and imbalanced market. In balanced market, the market moves in a specific range and your orders accumulate in that range. When there is a range, the sellers are buyers, sellers and buyers of both direction are trying to move the market in the same direction. The sellers are trying to move in the sell direction, the buyers are trying to move in a buy direction. But as soon as one wins, the market starts moving in the same direction. Whether it's the buyers or sellers, the market breaks out of that range and enters an imbalanced state. So what happened then next? The winning side inject momentum. The market starts moving aggressively in that direction. This direction, this directional move often continues for a while, creating clean structure and high probability setups. That's when we capitalize trading with the flow, not against it. Okay. Okay. Now move to live example for imbalanced market on the daily time frame. This concept is not limited to just one time frame. You will see it repeat across all charts from the 1 minute to daily and beyond. let's take a recent example of the daily time frame. The market has given clean structure and strong impulsive move, perfect directional flow. But if you look before this momentum started, you will notice something important. There was a balanced phase. Price was moving between a specific high and low. And how do we know it was a balanced market? Look at the wicks. They are filling each other from top to bottom. Each time price tapped a level, it reacted without breaking. Buyers and sellers were cancelling each other out, causing price to remain inside a range. So why this is important? Because that range acted as an accumulation zone. The the moment price broke out, the imbalance began and clean impulse move followed. You can use this structure and balance week plus range as a powerful signal to anticipate future breakout opportunities. Mostly we avoid balanced market, but if yes, you can still trade inside a balanced market, especially if a clear setup present itself as a well-defined range with clean reaction at the high and the low can offer solid short-term trades. But here's the truth: the highest quality, highest probability setup usually appears after the balanced market, not inside it. Okay. Why? Because once the range breaks, one side buys or sellers take full control of it. The market shifts into an imbalanced state with clear direction, clean structure, and momentum. That's when you get your sniper entries with minimal drawdown and maximum potential. So now, if you see here, the VIX is not filling each other. There are multiple imbalances here. So we have an imbalance market here. See here, there is an imbalance here. We also have an imbalance market here. So these gaps indicate price didn't mitigate previous zone. That means orders was skipped and momentum took over. So what does this tell us? That the price is moving fast in one direction without giving the other side a chance to react. This is exactly what we call an imbalanced market, where one side dominates and the structure is clean, directional, and full of opportunities. So we actually don't force the imbalance. We identify it. Our job is to spot it early, align with it, and trade with precision. So there are many examples in the background as well. If you see here, the market was moving in a range. After that, you can see an expansion in bullish direction. The market is converted from balanced market to unbalanced market. It shifts or the range fully finally breaks, and then we can see a beautiful trend continuation. Most of the time, whenever the market is balanced, the range is created in one direction. After the order sweep, after the liquidity sweep, in the next direction, we get to see the major moves. If you see here, the market from here to here The range you have was filling each other. Now see here. 1, 2, 3, 4, 5, 6. Almost for 9 to 10 days, the market has been moving in the same range. Sometimes the market goes up, sometimes goes down in the same range. The candles of the daily time frame keep closing in a range. So here also the same thing happened for almost 2 weeks. The market kept moving in the same range here. You can see after that, as soon as the structure continued, the trend continued. And if we go back, we can see many such examples. Here also, the market kept moving in the same range from here to here. Finally, after the sweep, we could see an expansion. We could see a healthy imbalance, and as a result, we could see a good increase. We could see a good trend continuing based on these. Based on these, we could take trades. Here, after the expansion, there is a pullback. Most of the time, the expansion is imbalanced. It leaves behind and fills up later. So the market with imbalance is better to trade. Here also the same thing happened. The market was in this range for almost 2 weeks, and again we saw healthy expansion. We saw an imbalance, and after filling it, the market continued a good trend. So here we can also see when the market is in a balanced range, we get to see good expansion, whether it is here, whether it is a bearish expansion here, or before this, you can see major expansion after this range. So what we learned today is balance and imbalance market. High quality trades are made in an imbalanced market. The market is structurally continuing a trend. So the key is, after a balanced phase, if we see a strong expansion and the market starts trending, we can enter with confidence and often get multiple clean entries in that direction. This is how you move from guessing trades to executing with purpose. So today's topic is simple, but it changed the game, okay? Balanced market. Price move in a tight range, orders accumulate, product direction is unclear. You can trade it, but only with clear structure. In imbalanced market, one side takes control, market breakout, trend forms. This is where you get high quality sniper level trades. So after all that, if I give you the main pro tip, this will be, after a balanced phase, if you see an expansion and trend continuation, that's your window. So take multiple trades in direction and ride the wave. This pattern repeats across all time frames. So watch it, master it, and flip it.